Hi, and welcome to the Adhesion Manager Spotlight today for Morgan Dempsey Capital Management. We're going to be covering the large cap value strategy. And on the line today, I have Principal Chief Investment Officer and Portfolio Manager Mark Dion. Mark, if you would please take it away. Thank you.
All right. Well, I thank you for having us on this session, and we appreciate the opportunity to share our product and process. I'll just move us past our agenda to the firm overview. Morgan Dempsey Capital Management is a registered investment advisor. We were founded in 1994 by Kathy Morgan and Tom Dempsey, both of who are no longer with the firm. Kathy retired in 2001. She was a portfolio manager. Tom Dempsey was a marketing person, and he retired after the current principals purchased the firm in 2010. We're a majority employee owned, about 75% owned by employees, 25% by outside passive investors that also can provide us some help on occasion. They are solid business people, so they can provide us with assistance if we need it. They're a good advisory group. We're headquartered in Menomonee Falls, Wisconsin, which is a little northwest of Milwaukee. And the firm currently has $340 million in assets under management, both in SMA and UMA, and that was at the end of the first quarter. We have 8 employees. We have 3 strategies: the large cap value, a small micro cap value, and the mid cap. The large cap value is the largest of the strategies. The large cap, a quick overview is that we are a dividend-centric large cap value strategy. Dividends and dividend yield are an important component of what we do in this portfolio. We have over a 15-year track record, and I've been managing it for 15 years. The product itself has about $223 million in separately managed accounts, as well as the UMA model accounts, as of the end of the first quarter. What's important is that the vast majority of our accounts come from wealth advisors, financial advisors, probably like most of you who are on this call today. We're a bottom-up, fundamentally research approach. That's what we use for our selection of stocks. And that bottom-up approach also helps to drive and will drive the asset allocation or diversification within the portfolio itself, because we're really bottom-up driven, and that drives all parts of the investment process. We emphasize total return, and that's important because we're not just a yield portfolio. What we're looking for are companies that have long-term catalysts that make them attractive long-term holdings. And for that reason, you'll see that our portfolio's performance, has been strong on a total return basis, as well as providing good dividend yield to the folks that own it. It's a concentrated portfolio. We'll own between 30 and 45 positions because we believe everything that we own should have an important be an important contributor to portfolio performance. We have a long-term investment horizon. When we buy something, we want to own it for at least 3 to 5 years. So one thing, and Sandeep will talk about this, that we want are companies with long-term catalysts. We're long-term holders. We want to own them for 3 to 5 years. We want them to have that catalyst that will allow us to own them and make good money in the process. We're benchmark agnostic. That doesn't mean we don't know what the benchmark looks like. We use the Russell 1000 value, but the allocation within the portfolio, sector allocation, is not going to be driven by the benchmark. It's going to be driven by where we find value. And so while we know what the benchmark looks like, we know where our risks are with respect to the benchmark, our portfolio probably is not going to look like the benchmark. In the portfolio management team, we're both analysts and portfolio managers. I'm Mark. I've been on the portfolio for, for 15 years. And Sandeep joined in 2011 and has been working on the portfolio ever since, and is a co-portfolio manager with me. The investment philosophy is pretty basic within what we do. We're a dividend-centric large cap value portfolio, and our objective is to generate both a high level of income and a total return that exceeds the benchmark on an absolute and a risk-adjusted basis over a market cycle. And the risk-adjusted is a real important piece to us. We've always believed that being a portfolio manager, the big component of that is risk management, and this focus on risk has helped drive our long-term performance, which we think is as good as anyone out there, but particularly in terms of low low downside capture. What we're looking for are companies that have durable, profitable business models, uh, because we're looking for those companies that are going to be able to continue to produce good performance over a longer period of time. We believe that dividend income is important. That's part of our philosophy. And it's important whether the market is going up, 15, 20% a year or going down. And what we found is that people have a tendency to kind of laugh off dividends when the performance of the markets are strong, but then start recognizing them and get all excited about them when the markets are a little weaker, or in the current environment where interest rates are low. I just want to say that we've been looking at dividends and think they've been important before dividends became cool. I mean, we've been in this space for a long time. We want companies that generate significant cash flow, and the reason is pretty simple. It gives us both a comfort level that they will be able to continue to grow their dividend, but also it gives them the powder that they need to be able to reinvest in themselves and to be able to grow. Again, we're not looking for moribund stocks that are going to go nowhere but generate a high income. We're looking for companies that are going to generate a total return. So cash flow is essential. And finally, we're patient buy and hold investors. We are going to hold these stocks for a long period of time. And one other part of our investment philosophy, and this has become really important during the current environment, is that we really look to include what we consider to be non-traditional dividend names within the portfolio. We don't want to just own utilities, REITs, and telecoms. I mean, you want to be out there in other parts of the market that have strong potential growth characteristics. And what we found is the market has actually come to us, where there are a number of companies that you'd never think of as traditional dividend stocks that we now can buy and own for our portfolio. I mean, a classic example is Cisco Systems, which we own, which is, one would think of it as a yield stock. When we purchased it, it was yielding over 3.5%. So again, you can find interesting names out there which allow us to run a more balanced portfolio that not only has yield, but contributes strong total return to those to our clients that own it. Now, getting into the investment process, I'm going to turn this over to Sandeep Breon, who's been with us for, again, since 2011, and is a real crackerjack analyst. I'll turn it over to her.
Thanks, Mark. Thank you all for joining us, and I appreciate you giving us the time and the opportunity to talk to you. So I work with Mark on this large cap product, and we both manage, and I've been with Morgan Dempsey since 2011, and we have a great time doing this together. So before we take a dive into the process and give you a little bit of an introduction, I do want to emphasize and encourage you to look at our risk-adjusted return next to our peers, and also our upside and downside capture ratios, which are very encouraging, and I'm guessing you'd be positively surprised. So with that, I'm going to dive into the process. Our process really is centered around 3 pillars: the dividend yield, the fundamental analysis, and the valuation. In the stock selection process, when we're looking at the dividend yield, we're looking for companies where the dividend yield is 100 basis points higher than that of the S&P 500. We're looking at the management's commitment to that dividend, and we're trying to identify if there's been any change in the dividend policy or strategy historically, or if management anticipates any change going forward. Now, there are several sources of idea generation, but our holy grail is our screen. In our screen, we're looking to pick out companies that have a greater than $2 billion market cap and pay a dividend and have a history of dividend growth. And we scan this screen pretty regularly, and we're looking to identify names that seem appealing. Now, once a name catches our attention, then we take a deeper dive in it, and we're looking to answer several qualitative and quantitative items. We begin with trying to understand the business model. And with that, we're really looking to answer the question, hey, how did you grow up? How did you survive for the last 10, 20 years? What has been your past strategy? And in order to answer those questions, we're looking at and reading 10Ks, annual reports, and talking to management teams. The next question that we're looking to answer is the growth potential. And the question really is, Where are you going to from here? What is the strategy? Has there been a change in strategy? Because a lot of times, what we find is that when the companies start showing up on our screen, it's because management has identified that their prior or historical strategy isn't really working, and it's time to attract a different set of investor base. And Mark alluded to that earlier when he was talking to Cisco. I'm sure you are all familiar that in the go-go days, Cisco was all about routers and switches, and they wanted to fill this whole world up. And to an extent, they did. But then they realized, hey, you know what? There are only so many routers and switches that can fill up this world. We need to do something different. And the stock at that point, it changed from being, a go-go growth stock to now a value stock, and management initiated a dividend strategy. And now their long-term strategy has been that we're no longer going to focus so much on hardware, and we're going to focus more on network security and software and head in that direction and pay a dividend. So that strategy really attracted us to that stock, and we started a position in it a couple of years ago. The other aspect of the fundamental analysis that is pretty key to us is to identify the free cash flows that the company is able to generate, because we want them to be able to cover their dividend, not just now, but going forward as well. Our secret sauce, as we often tell our investors, is that we look for a long-term catalyst. The reason we do that is to avoid the inertia that's generally exhibited by value stocks and to avoid value traps. Now, that catalyst can come in different shapes and forms, right? It could be a change in a major CapEx program. It could be a significant change in the business portfolio, or it could be an implementation of a total shareholder return policy. So for example, a couple of years ago, Chevron had been dumping a lot of money to develop their Gorgon field. But then we identified that, hey, they're going to stop doing this, and it's time to realize cash flows from all their investments that they've made in the past years. And the reduction in CapEx is going to benefit the free cash flow and also the holders of the stock in terms of the dividend that they're going to pay out. So we started a position in the stock, and it has benefited us well. A significant change in the business portfolio would be in the case of P&G. So P&G looked at their portfolio and they said, hey, this isn't going anywhere. We've got more than 100 products. And they decided to trim that portfolio down from 100 to 65 and focus on key products. So 21 of those are in the range of $1 billion to 10 billion, and 11 of those between 500 to 1 billion. So that strategy to focus on your key core products appealed to us, and hence we took a position in the stock. Now, once we've identified that a stock is interesting and it checks all the boxes, then we take a top-down look at the portfolio and make sure that it meets the criteria that you see on this screen. So we don't want to violate an industry limit of 25% or a sector limit of 35%. And if we're not doing that, then we will start a position at about 2.5%, and the maximum that we will let a position run up to is about 5%. And as Mark has already mentioned, we're looking to manage a concentrated portfolio, so you will likely not see us go, more than 45 securities. The dividend yield will be in excess of the S&P 500, and the cash component of the portfolio garners some attention from time to time. And I'm going to pass it over to Mark so he can talk a little bit more about it.
Yeah, the portfolio currently has about a 16% cash position, but it's important to realize that this cash component, it isn't a tactical component. It's not like we're saying, oh, the market's going to drop, so we're going to have a larger cash position. The cash component really comes about passively. And what I mean by that is that we're continually getting dividend income in. We'll occasionally be trimming back stocks or selling a position, but we're not going to go out and buy anything unless we find a stock that we believe fits all of our investment criterion. And that not only means the dividend yield, but the fundamentals, as well as the valuation and the long-term potential. we're, a long time ago, I figured out that, purchasing stocks that you don't really believe in and thrusting them into the portfolio just to be fully invested is kind of a loser's game. And so for me, and the way that I've always approached investing is that I want every stock in that portfolio to be of value. So if we can't find anything to purchase, we will allow the cash component to passively grow. And at this point, it's about 16%. There were some names that were starting to get a little more interesting until the market decided it wanted to rally again. But again, we're not going to force ourselves to buy anything. Now, it's about as high as we'll let it go. But it's just important to know that that component is in there, and that it's a function of not being comfortable with current potential investments and waiting until we can buy the interesting names that we would most likely want to own, at a more attractive price. Our sell discipline is, I want to call it, in a way, it's fairly soft. And the reason for that is that we're holding these securities for long periods of time. And so if a stock is still doing what we expect it to do, is growing its dividends, is generating decent growth, but maybe slightly above where we think is a fair valuation. I mean, we will be willing to cut it back, but we don't want to be forced to sell it. We don't want to set a price and say, hey, at $25 we're selling the stock, because what you find is that there is is that you want to maintain, I guess, a dynamic valuation approach. You want to be willing to hold on to a long-term stock if you still see that upside, and be willing to adjust your price or yield where you would expect to sell it, adjust that over time. And so, but regardless of that, what we do look for, and what will draw our attention are basic signals of deterioration within a stock. I mean, if the cash flow dividend coverage declines below 1 times, I mean, obviously you want it to be able to cover its dividend. If this is just a temporary issue due to perhaps an acquisition, we can live with that, and we will. But we will go back and review the stock more closely. Significant balance sheet deterioration is another thing that will cause us to look back, and that's often the result, of a large acquisition. The only real cut and dried, if you will, sell a sign is if a dividend is cut. In that case, we will sell the securities, probably not immediately, but we give, because oftentimes you get a reaction, sometimes positive, often negative, and so you wait until that works its way through and then sell the stock. But it will be out of the portfolio probably within 6 months. If the yield declines significantly below its historical range, again, that's just a more obvious valuation parameter that you see, and it will, and it's something that again draws our attention. And we're more likely, if all things being equal, if every stock is working fairly well, to sell those to be more likely to sell a stock that is the lower yielding in the portfolio. And then and then the last point would be, if we find a better investment alternative, that's always there. I mean, if you find something with a higher yield, that's better valuation and has a better long-term outlook, that's a stock that you will buy. And if you are at a point where you are fully invested, then you would swap out a less attractive name at that point. So I mean, as a conclusion on this, to sum everything up, I mean, what should you expect? What should a client expect within this portfolio? And it's pretty, and to me, there's some pretty straightforward things. I mean, you're going to have 30 to 45 stocks. The market yield, or it's going to have an above market yield, and generally significantly above market yield. It's going to be concentrated in higher yielding sectors of the market. I mean, it's not going to be, they're not going to be completely dominated by those, but there is going to be a significant exposure to staple stocks. There is going to be some ownership of utilities. We own some REITs. You are going to see those stocks in the portfolio, but because of the nature of the market and where stocks are going, and stock philosophy, I guess, are going, you will see more what I consider non-traditional stocks within it. We have in the past owned MLPs. We won't, just because they're just a pain from a tax standpoint. And you'll see generally low turnover. I mean, recently it's been very low. We've been comfortable with our positioning, and I mean, it's been below 10%. we generally, I mean, if we hit 25% turnover in a year, that's unusual. And again, that's a function of our long-term holding, of our long-term desire to hold stocks, over a large period of time. Within the portfolio itself is objectives. You should see significant and rising income stream coming off of it, which is very attractive, particularly in a lower rate environment. We're going to have weak relative performance during strong market upticks, and we've held up quite well this year, which is pretty exciting. But generally when you see a pretty crazy market environment, we are going to underperform, and you just have to expect that. That's just the nature of the beast. But we generally, in weaker and negative markets, is where we make a lot of hay. Our downside protection is quite significant. I mean, if I'm just looking at it from over the various time periods through our own calculation, our downside capture has been anywhere from 37% to 54%. During the 3, 5, 10, and 15-year period, which I think is very significant, while our upside has been generally in the high 60s to low 70s. So, I think that that's a very compelling risk-return profile for the portfolio, and it is a reason to seriously consider it at this time, both not only because of the dividend component and the yield component, but because of the downside protection. And as we saw at the end of 2018, no matter how exciting the market can seem, yes, it can still lose money. And we're very proud of our ability to protect on the downside. And that's really all that we have to say about the portfolio itself in our investment approach. And if there are any questions out there, we'd be more than happy to answer them.
Fantastic. Thanks so much, Mark. That was great. This seems like seems like a really good fit for a UMA. If you look at the list here in the slide, it's 30 to 45 stocks. Generally low turnover with an above market yield. This is something that works really, really well in the adhesion environment for our advisors. So really excited about having it on the platform. One question did come in here. So what role overall do you see this model or this portfolio playing within a larger portfolio, like in the context of someone's entire holdings?
Well, I mean, we've seen it used in a couple of different ways. I mean, I think it can be used as just a classic large cap value piece. We have seen it used that way in some larger accounts. We do have a handful of foundations that have used it in that way. But I think also it has been used, if you want to say, almost in its own bucket, but for its income component, where clients who are looking for looking for a higher level of income, particularly with what the bond market has been able to give at this point in time, have turned to this type of an approach. Again, it's lower risk profile, and its higher yield has been a real. Folks have used that, as an income piece. I don't know if you'd almost call it like a hybrid. I know people used to put old, convertible pieces in the portfolios before. I mean, in particular these larger, the large ones. I mean, it may fit in something like that. But also, I mean, because it outperforms the Russell 1000 value it has over the long term, because it is a value portfolio, we've also seen it used as that piece of larger significant portfolios.
Fantastic. Thanks very much. And like you mentioned, we have been seeing more and more requests for this type of portfolio that basically can provide a rising income stream over time, but something that also emphasizes total returns, especially with the bond market the way it is, like you mentioned. So this is very, very compelling, and we're super excited to be working with you guys.
One other thing that I will throw out is this may open up the floodgates, but we are willing to talk if there are significant clients, or if there is an organization, if you're thinking about using us. We're very open, to discussing the strategy further, or helping talk about the strategy to a larger client. And we try to service folks as best we can, and give them what they need to be able to sell our product.
great. We really, really appreciate that. And any advisors listening, please feel free to reach out to your relationship manager if you're looking for something like that. We can get in touch with Mark and his team for this. So, and with that, just wanted to, I think we're out of time, but want to say thank you very much today. It's been a great presentation, and yeah, if you guys have any questions, please reach out.
All right, thank you,
Thanks.
and thank you everyone for listening to us.
Thank you.